Hello, everybody, and welcome. Today, I'm speaking to Nigel Birnie, one of the top experts in the island of Ireland in the field of trade credit insurance. So, as the economy opens up post-COVID and all the government support that has been so useful over the last 12, 14 months is withdrawn. Gradually over the course of the year, there's a bit of a concern that some businesses that have been kept afloat by these measures will no longer be able to continue, and we may see a wave of insolvencies. So Nigel's going to talk us through how we got here, his concerns for the future, and how trade credit insurance could be a part of the solution. So welcome, Nigel. And first of all, you and I have known each other a long time. What exactly do you do? Tell everybody what you do.
Okay, David. Well, first of all, thanks for the invitation along this afternoon on behalf of Navigator Financial Planning. What do I do? Yeah, it's a bit of a mystery for a lot of people, but what I could do, I head up the trade credit division of Willis Towers Watson in Northern Ireland. Willis Towers Watson are a global company with something like 40,000 employees. We're in the process of combining with Aon, which should happen later this year. So the Willis Towers Watson Aon combination will be a very big player in the whole insurance market. So I head up the trade credit division in Belfast. Willis Towers Watson Trade Credit. We're the largest specialist credit insurance intermediary in Ireland. We're the largest and best resourced. We have our clients have a combined aggregated turnover of something in the region of 2 billion. So there's 2 billion of insurable sales arranged through Willis Towers Watson in Belfast. With our Dublin yard and our Dublin office, that goes up to about 10 billion of annual sales that are insured. Our typical customer, well, if there is such a thing, we would have companies with a turnover of several hundred thousand, going up to companies with several hundred million. So it's a broad brush and covers most, if not all, of the industry sectors. And so we would be a very dominant player in the trade credit insurance sector in the island of Ireland.
Okay, excellent. So, so what's the problem that you're trying to solve for your customers?
Well, I suppose maybe it's not really a problem. What we do is provide options for companies that want to manage their credit risk. So, credit insurance covers the sale of goods or services which are sold on extended credit, and during that credit period, the customer could simply go bust and cease trading, or at the end of the credit period, that company maybe has run into cash flow issues and may not be able to discharge their debt. So, credit insurance is what a lot of businesses now are using just to have that level of financial protection against bad debt.
Okay, so I think what you're saying is, if I put it in my layman's terms, you're saying it's a way of ensuring that you're going to get paid, whether the company that you've sold your goods or services to survives or not. Is that a fair summary?
Yeah, well, that's fundamentally what credit insurance is there. It gives people or companies that peace of mind, that safety net, that should the unforeseen happen, that they're not going to suffer financially. And even a debt of a relatively small debt of maybe 10 or 20,000, that can have huge ramifications for a business, because all businesses are under pressure now. Their margins are under pressure. So if you're fortunate enough to have a gross profit margin of say 10%, and you take a debt a hit for say 50,000, that's 500,000 additional sales you have to generate just to stand still. So when you put it in those terms, then you can see how sometimes being hit by a bad debt can be fatal for businesses.
Yeah, I think it just takes a wee bit of getting your head around that. I remember my father years ago saying to me, because when he was in the wholesale food business, and he used to say to me, if somebody didn't pay a bit debt of £500, it's not £500; it could be 20 times that. And it's what you've explained that exactly in a helpful way. So so talk to us about last year and this year and your thoughts on that. So how did we get here into the situation we're now in, Nigel?
Well, I suppose this time last year, the whole world turned upside down, and certainly COVID and the pandemic certainly had huge bearing on the credit insurance sector. Now, thankfully, the British government, like a lot of governments in Europe, seeing credit insurance as being pivotal as to help businesses recover and reinvigorate themselves, and as we look to rebuild our economy post-COVID. So the UK government put in a 10 billion guarantee into the UK credit insurance sector, which certainly stabilised things, because this time last year, as we headed into even April and May, the first few months of the pandemic, certainly the outlook was very bleak for a lot of businesses. And that's why the government's thankfully stepped up to the plate and said to the credit insurers, listen, we will pay all the claims that's going to be coming through in exchange for you give us your premium. So the underwriters had to cede 100% of their premium in return for the government picking up the bill for all the credit insurance claims that were expected at that point. Now, having said that, the sort of the claims, the credit insurance claims have been pretty benign, because the roof didn't cave in or fall in, simply because there's other state aid packages which have been introduced, which has allowed businesses to trade through. A lot of economists would forecast that we're simply kicking the can down the road a bit, but certainly at this point in time, credit insurance claims have not come through to the level which was anticipated. Having said that, we processed probably one of the largest claims in the UK in the last 12 months. We had a client who had a customer who ceased to trade, owing them £7.5 million. So that company, was very glad that they had credit insurance in place. For a few years, they questioned the value of credit insurance, but thankfully they kept renewing. But there was certainly the same discussion each year: is it really worth it? Is it really worth it? All of a sudden, bang! They got up one morning and realised that a customer that owed them £7.5 million was no longer there. So I suppose the attitude changed very dramatically, thinking, thank goodness we've now been paid. But the impact, if that claim had not have been paid and that company hadn't had credit insurance, that level of debt would certainly have threatened their very existence. And not only their existence, potentially the existence of a lot of companies in the supply chain. So so that claim was processed and processed pretty quickly. So we're in a situation now where, eventually the various state aid packages will be withdrawn by the government, and the expectation is then that there's a lot of companies out there with literally just their head above water at the minute, which unfortunately they probably will go under once the various packages are withdrawn, and that's when we expect to see a spike in credit insurance claims. Certainly the latter half of this year and into 2022. So
you've talked a bit to me about, and you read in the the sort of economic press and the financial press about zombie companies. Is that kind of what you're talking about, Nigel?
Yeah, absolutely. The underwriters know that there's companies that don't have a particularly strong balance sheet, but they've got their cash flow at the minute is really based on the various C bills, B bills, grants, whatever it is coming through. And I say once that artificial cash, if you like, is withdrawn, then we fully expect, and we're bracing ourselves for a surge in insolvencies, unfortunately, which will lead obviously to further credit insurance claims. And that's what we're saying to companies at the minute. Don't wait until the claims start, or because it's a bit like car insurance to some extent, credit insurance. Too many companies come and speak to us once they've been hit by a bad debt or a few bad debts, and they say it's like car insurance, where if you go looking for insurance after you've written off 2 or 3 cars, you're not a very attractive proposition. So we get companies saying, "Oh, I don't have bad debt. I've never had bad debt." Well, that's actually the best time to come looking for credit insurance, and that's when you can get the most competitive options, shall we say.
That's interesting. So I would have thought that the premium, the cost of this, would have been based on your book, who you were dealing with and so on, rather than your own experience. But the sound of things, I think what you're saying there, it's maybe a bit of both. Is that fair, Nigel?
Yeah, the algorithm that sort of makes up credit insurance pricing is based on a number of things. Your spread of debtors, the geographical spread of debtors as well, bad debt history, and so on and so forth. So, but bad debt history is certainly a big factor. In fact, if your bad debt history is particularly poor, then it's probably unlikely that any credit insurer will quote. So there's a lot of focus on bad debt history, and which sort of says a lot about maybe your own in-house credit control function. If you've been constantly hit with bad debt, obviously the due diligence obviously is not there. Now everybody can get hit by a one-off bad debt. That happens. It can be unforeseen, but if there's consistently levels of debt, then it would raise question marks and red flags with underwriters.
Yeah, I mean, this is all really interesting because you're saying people say, do I really need this? And it's the same with us with the likes of life insurance or illness insurance. And I say to folk, look, I hope this is the worst investment you ever make. I hope you never have to claim on it. The bottom line is you might have to. So maybe this is a how long is a piece of string question, but I'm going to ask it anyway. What's it likely to cost?
Yeah, it is. It is a bit of a you can't just say a fixed price, but if as a rough rule of thumb, if you're and you have a turnover of say £1 million, you're probably 0.5, 0.6%. So that's £5,000 for £1 million of sales. Go to 10 million, you're probably talking maybe 0.3. Go to so the higher the turnover, the lower the rate. So
okay.
As a rough rule of thumb, about £5,000-6,000 for £1 million of sales, and then the economy of scales kick in as the turnover goes up, the rate will come down.
Okay, that's interesting. That's less than I thought it would be, and I guess like ourselves, there's a kind of a standard rate of somebody applies for life insurance cover and they're in good health, it all flies through, and you're sort of saying, well, that's kind of what it's going to be. But if they go along and maybe they're in a high risk business or they have a bit of a history of a few bad debts in the past, then it might start to creep up a bit. Is that how it works?
That is how it works, but there's other factors to the geographical spread of your customers as well. Are you trading in some sort of high risk countries, so to speak? So yeah, it's a bit of a mix, but certainly don't wait until the best advice. Don't wait till you've been hit by bad debt before looking for credit insurance, because unfortunately it'll impact the cost.
So you have raised a couple of questions that I was going to ask specifically, and one of them was there. It sounds like you can insure overseas debtors.
Yeah, there's a few sort of, I suppose, misperceptions out there when that companies maybe push back against credit insurance. First of all, it's very expensive. Well, I've just given you some indication of pricing. It's only available for exports. Credit insurance is a global product, and so you could have your customers can be spread from Belfast to Bombay. It doesn't really matter where the customers are. It could be a mix of domestic debt and export debt, or just export debt, or just domestic debt. So it's not just for exporters. And underwriters don't just cover the Googles or Apples of this world. Otherwise, there'll be no credit insurance claims. The fact that there are no claims paid out will say that credit insurers are taking risks in underwriting debt. Otherwise, there wouldn't be claims. So it's not fair to say that underwriters only cover safe risks or good risk. And credit insurance it's not difficult to administer. It's a very straightforward product, but it's not a product to buy and stick in the drawer and take it out again in 12 months like other types of insurance. It's part of your day-to-day credit control function.
Okay, so just open that up a wee bit. What do you mean by that?
Well, every day, you could be most companies are looking to build and grow, and credit insurance helps you to grow your business safely by using the market intelligence that's provided by the underwriter. So, if you want to trade with a new customer, the first thing you will go to the underwriter and say, will you cover this customer that I want to start trading with? And they'll come back and say, yes, David, what level of cover do you want? We'll say, well, I need 100,000 cover on Navigator. And the underwriter will say, yes, that's fine. So you can trade, you've got 100 grand cover there. But there's times the underwriter will come back and say, sorry, David, we cannot write cover in that business because we've got serious adverse information in that business and we're very concerned about its viability and we're not writing any cover. So you think, thank goodness, to learn that. It could be because they've got financial information to show that they're very weak financially and so on and so forth. But the information is of such an adverse nature that the underwriter's not covering. So that obviously will change your conversation with your prospect. You might say, okay, I'll still trade with them, but I'm not getting paid up front. If the underwriters want to take the risk, then why should I? So you get all this sort of market intelligence from underwriters to allow you to make better commercial decisions for your business.
That's again, this is news to me. This is interesting that it all becomes part of your due diligence, becomes almost part and parcel of getting into bed with a new customer, and you might want to do that work a wee bit upstream before you get too embedded, wasting time doing contract negotiations or anything like that.
Absolutely, and that's the message we always say to our clients. One of the first things you should do when you're looking at taking on new customers is to do your due diligence and do it early, and don't wait till you started trading and say, oh yeah, I must apply for credit insurance, and then the credit insurance refused. So yeah, that is very sound advice to customers. To do that's what the credit insurance is there for. It's not just there as in case you get hit by bad debt. It's different facets, and one of the facets is to help you to grow your business safely.
Yeah, that actually sounds like a really good title for this interview, and that will maybe think about that. So kind of leads on to another question I had was, so can business insure specific debts or just part of their book, or do you have to insure your whole book?
That's a very good question, and it's one we get asked quite a lot. The most cost-effective way is to insure your whole turnover, because then you've got you have a basket of risk, the good, the bad, and the ugly, and the debt. Then it's spread. So that's the most attractive proposition for underwriters. However, you can, if you've got maybe 90% of your business with one customer, insurers you can have single debtor risk covered. You can have, some of our clients maybe exclude cover on the large multiples, like maybe your Tesco of this world. They maybe supply them, but don't necessarily feel the need to insure. So you can be selective, but I suppose the most cost-effective way is insure your whole turnover. And I suppose 90% of our clients, that's what the way they do operate their credit insurance.
And I guess from your point of view, and indeed the whole market's point of view, that's the best way to get the most effective market intelligence if the whole pot is in there. Yeah. So so one last wee bit of detail that so you mentioned the 7.5 million. If a business fails, is 100% of the debt insured, or can you dial it up or what?
No, the level of indemnity, the standard level of indemnity in credit insurance is 90%. Okay. So that it's not the full 100%. It's 90%. So in that case, that particular client got 90% of 7.5 million. Okay, so they had to take the 10% themselves.
Almost like an excess in car insurance or something.
Exactly. And I suppose the other thing we need to I suppose clarify as well that probably 40% of our clients their credit insurance is accepted as collateral for banks and funders.
Okay.
Banks and funders look favorably on different types of finance facilities if the ledger is insured. In fact, banks usually become co-insured under credit insurance policies to give them a greater level of protection as well, and allows them to provide facilities that maybe they couldn't provide if the debtor was not insured. So it's all about access to finance as well. And again, as we look to come out of the pandemic, access to working capital is going to be so critical for businesses. So having credit insurance definitely will help and enable businesses have greater access to funding.
Again, that's just fascinating and interesting. Have you a war story that you want to tell us? Have you some? You've told us the 7.5 million. That's the biggest one. Is there any other words of wisdom or tales that you can tell us that people would find interesting?
Well, I suppose that particular story is probably dominated conversations, shall we say. But I suppose the best credit insurance, yes, it's there as a vital means of protecting businesses against unforeseen debt. But on the flip side of that, the message we want to get out to companies out there as well is that we want companies, and we're advising that they take ownership of their own credit rating. Okay, and what I mean by that is obviously, if because so much has happened in the last 12 months, underwriters usually decide whether they feel a company is creditworthy or not on the basis of financial information, a lot of which is in the public domain. But sitting here in February 21, the last accounts that a company has to file for regulatory purposes is, say, December 2019. So it's very difficult for an underwriter to assess the financial health of a business, given what we've all come through in the last 12 months, looking at a set of figures which are 18 months old. So the best advice we're giving businesses at the minute is to make sure that they are providing credit insurance underwriters with up-to-date financial information, whether it's management accounts, whether it's details of their bank covenants, their order book, all these sort of details, to make sure that their credit rating is not withdrawn or downgraded, which could impact their whole supply chain. So it's a very strong message to companies that they definitely make sure that you are providing insurers with up-to-date figures on the details of how your own business is performing. So, as I say, to just protect your credit rating and ensure there's no supply chain disruption.
Again, I don't think many people would know that there's that opportunity to proactively go and interact with the likes of yourselves. So I've learned a lot here, Nigel, today, and maybe our business isn't necessarily a potential customer of yours, but lots of our clients will be, definitely, because we deal, as you know, with a lot of small and medium-sized companies, our target audience, as it were. So how can people get in touch with you, Nigel?
Various ways, David. Obviously, your clients can come through yourself. You can pass on my details. You can come through on LinkedIn. Certainly, probably the easiest way to make that connection. But we'd be delighted to provide options to every business. SMEs make up the majority of our business. It's in Northern Ireland's an SME economy. But it's probably the SMEs are most vulnerable to bad debt at the same time. So, aside of, as I say, but about credit ratings, that's something we can provide advice and guidance on as well. So, we're here to help Northern Ireland PLC as much as possible. So, any issues, any clarification information, please, businesses don't hesitate to talk to us.
Well, thank you, Nigel. I found that really interesting. I thought I knew what credit insurance was all about. I really didn't. So what I've learned is not only can you help businesses insure in a very boring and static way, but you can, I love that title, help you grow them safely. You can be a part of how people grow their businesses and be almost part of that little bit of intel inside the Northern Ireland economy to help businesses in general, just as well as your clients to grow their business. So thanks very much for that. I really appreciate that. So people, thanks for listening. I hope you found that useful. If you need further information about trade credit insurance, look, get in touch with Nigel at LinkedIn or come to ourselves and we'll put you in touch with Nigel. And of course, if you have any financial planning matters that you need help with, please do get in touch with us on our website or on social media. Well, thanks for watching and see you next time.